Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for April 3rd, 2023. It's great having you with me here today. And what we're going to talk about is ISM manufacturing. Came in weak again. We have seen a series of these prints over the last 6 months that have been on the negative side or under 50. We're seeing contraction in the space. And no doubt we are seeing the impact of the Fed tightening and how it's playing out. And that really does set us up for the future. But there are some really interesting numbers underneath that we should really pay attention to. One is employment. Employment has held up in manufacturing, even though the overall reading has fallen. Why is that? Businesses have been pressed not to let go people, because when they did let go people in March of 2020, it didn't go the right way. And so they really struggled to get back to that. But just recently, we've seen the turnover fall in manufacturing companies. And what that's telling you is there's not as much churn, there's not as much newer or different opportunities for places people to go. And so there is going to start becoming some ability to lower through attrition. And through attrition, we may then start actually seeing some layoffs. So it kind of works in a process. If there's less churn out there, businesses are a little bit better positioned to be able to work off their employment, because they're not always constantly having to fill positions which they really need. So they can kind of right size through that process. So that less churn is important. Remember, part of churn is the people you want to keep and people you don't want to keep. And typically in churn, you lose the people you want to keep. And so you're kind of running against Lucy in the Chocolate Factory idea. The other thing is prices paid. It actually went under 50. So that's a fall in prices paid. And in that, what was important was that the supply demand elements that have been out there, the imbalances, that has actually worked the other way now. So we're starting to see businesses saying, we don't have to over order. And by not over ordering, we can get a little bit better price. Because for the longest time, they've just been sort of ordering just out of a reaction to the market. And then as orders are about to be filled, they pull back a little bit. So that's something we should watch there. Further, if we get down to the export number, that did not come in as well as we've been seeing it. So there is some impact internationally, particularly in Europe, on the banking crisis and how that works through here. And talking about the banking crisis, new orders fell. They fell from a little bit of a movement up, now still contraction territory that we saw in February. March was a little bit down. Now, it wasn't as low as January. So it's not terrible news, meaning we're not seeing a free fall in new orders, but we want to be worried. We want to keep our eyes on it, because that's usually the first domino. And new orders is a leading indicator for the economy overall. So manufacturing side gives it a shout out there in terms of the economy. So yeah, new orders are an important indicator. That indicator is still negative, but not as negative as we go further. So holding in there as much as it can at this point is really the secret. Yes, gone are the era of, expansion, catch up, those parts of the economy. So the Fed's duty to slow down the economy, to get inflation, happened, and it transferred into the numbers in March. How long that persists for is something we have to keep our eyes on. But this number here does telegraph that 6 months, end of this year, economic slowdown is clearly on the horizon. This is Scott Murray for the Daily Economic Market Shout. Thanks for joining me.